Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today we're going to be talking about something that, frankly, I thought I would never ever get to see in my lifetime. I didn't even really know it was possible, but seeing crude oil futures go into the negative. What does this mean for the stock market? Is this something you should be paying attention to? Is this something that you should be investing in? Let's just explain it and really go over it because a lot of people don't even understand how crude oil could go negative. What is the difference between crude oil futures and the legitimate price of crude oil? So we're going to be going over that. We're going to be going over how it went negative. We're also going to be diving into Cushing, Oklahoma, something that hits home close to me. It's only about 45 minutes away from where I live. Cushing, Oklahoma is a very important place for crude oil, and we'll be going over why. We'll also be showing how future contracts work and be comparing that to options trade. Then we'll also be going over Qualcomm raising their dividend, Southern Company raising their dividend, and then we'll be updating our spreadsheets for our annual, monthly income. So let's dive right into that. And to get started, as usual, if you enjoy watching my content and you like watching my videos and you enjoy seeing me use M1 Finance and you're interested in using M1 Finance yourself, use this link right here. It's also in the description. You can copy and paste it and you can sign up for M1 Finance and we'll each get $10. I can use that $10 to put it towards the portfolio, and I will mention you in the video. So to get started, let's update you guys on my portfolio. So far for the day, this is another red day in the market. Every single stock I own except for Foot Locker, which is somehow well in the green. Every single stock I own, 29 of the 30 are all down. IBM just reported their earnings. They missed, and then Coca-Cola also reported their earnings, but they're still down even though they had a slight beat. And then overall in the portfolio on the day, I'm down 1.51% or about $26.32. And if we go to my all-time here, I'm up 7.92% or about $121.48, $119.01 in market gain. And what's always most important, as I always mention, the earned dividends, which is $2.47, which will continue to go up. An update on the biggest gainers and the biggest losers in the portfolio. Cisco Corporation, Whirlpool, which is still holding up very nicely. Foot Locker, NextEra Energy Partners are all doing very good. And then the only red stock in the portfolio still, which has been lagging, which I will be buying more of in my next deposit, is Caterpillar. We're down about 3%, but still being up on 29 of the 30 stocks that I own is pretty good. But at the same time, I would kind of like to see a few more down because I really don't want to be buying higher cost basis than what I originally bought at. I would like to have a situation with Caterpillar, for example, where I'm buying these stocks at lower than where I bought them at so the dividend yields can be higher. But either way, I'll be happy with whatever happens because market gain is nice, but I prefer the earned dividend. So diving straight into crude oil. So if we see here, an oil futures contract expiring Tuesday went negative in bizarre move showing a demand collapse. So if you see here, we can just skim through the article. I'll just be showing some of the highlights here. West Texas Intermediate crude for May delivery fell more than 100% to settle at negative 37.63 cents per barrel, meaning producers would have to pay traders to take oil off their hands. So this is the difference between a futures contract and just a regular price of crude oil. So the regular price of crude oil trades every single day, and that's what the current price is. That's what it's worth, the current spot price. So basically, a futures contract is an agreement between sellers and buyers to sell crude oil at a specific price. Now, futures contract trade in the future. So as you can see here, crude for May delivery. So right now it's April. As of this article was written yesterday, so it was April 20th. And we're trading for the future price of May of 2020. So that's why it's called the futures. So basically what that settled at is what people who had the contract for May of 2020 are going to have to pay for the price of crude oil. So one of the reasons why it went negative is this place right here. It's called Cushing, Oklahoma. Cushing is about 45 minutes away from me. And if you read this little paragraph here, for May WTI, the problem is compounded because the contract is settled by physical delivery at Cushing. Storage at the Oklahoma facility is expected to be full within weeks. Brent is not constrained by this requirement for physical delivery. So storage, here I'll highlight this here, storage at the Oklahoma facility is expected to be full within weeks. So basically, Cushing, Oklahoma, which has a huge storage facility for crude oil, is getting so full and is overflowing with barrels of crude oil that it literally cannot sustain any more barrels being held in it. So suppliers are literally having to pay these facilities at Cushing, Oklahoma to take it off their hands. Now, obviously, if you're a crude oil company, you want to sell crude oil for as high as possible, preferably, obviously, at a profit. That's how you make your money. So if we go to some of our main oil stocks here, I'll just search some of the big names. So let's search like XOM, ExxonMobil, for example. If we look at their stock price today, they're pretty much flat. They're down 2 pennies. And for the week, they're up. You can see that little dotted line there is where they were a week ago. They're still up on the week. So let's look at Halliburton, for example, another oil company. If we look at Halliburton here, they're up on the day a nickel, and for the week, they're up a couple percent. The same thing if you look across the board. So if like we go to Chevron, for example, if we search Chevron, Chevron is doing just fine. They're only down just less than 1% today. And for the week, once again, they're up on the week. So this doesn't make sense. How would we have oil futures contracts being sold in the negative if these oil companies are doing just fine? Well, first of all, there's two different types of crude oil. And another thing is that these future contracts are usually traded way out in advance. So these large oil companies that are worth billions of dollars, like Chevron, for example, $156 billion, will trade contracts 6 months, a year, 2 years out, and will have specific prices set already predetermined. So I'm just making up a number. So Chevron, for example, will get with the supplier. Okay, so we'll agree to sell crude oil at a price of at least $50 for the next 3 years, and they'll enter that agreement. So the reason why this went negative is because the speculators, the traders. So I'm going to be showing how a futures contract works and going to be using an options trade to demonstrate this. So this is an options trade. I'm on the S&P 500, S&PY, Spider ETF, and I'm in the options right now. So I'm about a month out. We're buying a call on an options trade. So this is how you would do it. What an options contract is, it is a contract for 100 shares of a stock. Now you can do calls and you can do puts. Call means you think it's going to go up. Put means you think it's going to go down. So if I'm buying a call on the S&P 500, this is a month out. By May 22nd, the stock has to be $13.06 above the current price, which is $275.62. So basically, the stock price has to be $13 higher than this price right here. So it basically has to be $288 and some change for me to break even. Every dollar it's higher than that $288, I make $100 in profit, because 1 times 100, because I'm buying 100 shares. So basically, when this stock reaches past that price, I'm having this contract to buy it at 276. At 288 is my break-even point. Even though the stock is at 288, I get to buy it at this price right here, the price of the contract, $276. So basically, I'm getting the net margin on the price of the contract for the shares. So I'm buying it at 276, but the price of the stock is 288. So the difference between 276 and 278 is my profit. In this case, it would be $12 a share, and you would be buying 100 shares. So basically, what you'd be looking at is $1,200. Now, obviously, you'll be paying the price of this contract, so that would eat away at your margins. So that's why you try to get it significantly higher. So, for example, if this went to $300 a share, you would have a $24 difference, and then you would minus $13 from that. That would leave you $11 per share worth of profit. Times that by 100, you have $1,100 of profit. The problem with this is that similar to futures, they have expiry dates. So if at May 22nd, if I buy this contract today for $13 a contract, and then by May 22nd, the stock does not go up. I bought a call, let's say the stock does not go up. Then this contract will be worthless, because it is not the obligation to buy the stock, but the legal right to do so. So if I buy this contract, this does not mean that I own the S&P 500. It means I have the right to own the S&P 500. You're not buying the actual stock itself. You're buying the right to buy the stock, a contract to own the stock. So the same thing goes with futures. You can also do this with puts. The same thing, but in reverse. It's just the inverse of this. So it's $276 contract. The stock is trading at 275. As you can see, these are in the green, up about 30% today. This contract is trading at about $14 a contract. So I have to minus $14 from this number, which will make it $262. If I were to buy this contract at $262, that would be my break-even price, and then every dollar below that, I would make $100. If that makes sense, that's pretty much essentially what futures do in a similar sense, but it's usually dealing with stuff like commodities. It's not so much with stocks. So as I mentioned earlier with futures, is that speculators will use these contracts to get exposure to assets and commodities such as crude oil. So in the same way with a put option, as if you want the stock to go as low as possible so you can get as big a profit as you can, the same thing goes for those going short on the futures contracts. If you're going short on a crude oil contract, for example, that is $20 a barrel, and it drops to $10 a barrel, and that's the spot price when it expires, then the $10 a barrel will be your difference. So if you had like 100 barrels, for example, you take 100 times 10, and 10 times 100 is 1,000. So 1,000 would be your profit. So this is basically what people are doing, where it's getting so bearish that these storage facilities can no longer even hold the oil that they're bringing to them. Another paragraph here about Cushing is storage is a major issue at facilities in Cushing, Oklahoma. The major U.S. crude hubs started to fill up. In addition, floating storage held in offshore tankers has doubled over the past 2 weeks to record levels of more than 160 million barrels. So basically, these storage facilities, especially the one in Cushing, Oklahoma, which is one of the most important for crude oil prices, is overflowing, and they honestly just have nowhere to take it. And it's talking about the different large oil companies here, about how they have been climbing, but they're having these issues with the contracts and stuff like that. What's more important here is that showing, for example, back to options contracts. If I go to April 22nd, today is April 21st. Now these contracts are trading at $3, but the ones we were looking at that were a month out, they're trading at about $13. So $10 more a contract. As you get closer to the end of these contracts, the more worthless that they become, regardless of whether they're going higher or lower. So these contracts become worthless. They're depreciating assets because you're on a time schedule. Because if you don't make a positive gain by April 22nd, which is 1 day from now, then these contracts will utterly be worthless. So if I buy this contract and by tomorrow it does not go up significantly, I have zero. So the contracts that expired today are obviously not as meaningful as the ones that are out 1, 2, 3, 6 months out, a year out. So if you look here in the article back on CNBC, as you can read here, this negative price has never happened before for an oil futures contract. Futures contracts trade by the month. The June WTI contract, which expires on May 19th, fell about 18% to settle at $20.43 a barrel. This contract, which was more actively traded, is a better reflection of the reality in the oil market. The July contract was roughly 11% lower at $26.18 a barrel. So this gives you a better idea of what crude oil is actually worth and what the contracts are really like. As you can see here, they were talking about the volumes for the May 2020 contract were extremely thin, and basically any and everybody who owned it were selling it for as little as they could. So these contracts in June, July, and further out give you a better idea of what crude oil is actually worth, because these are the futures. This is not the actual price. This is a future contract for the price, if that makes sense, just like we showed with put options. So as I mentioned here with options trading, the contracts that are closer to the expiry date are more worthless than those that are further out, because the further out you go, the more realistic timeline you see. So the same thing that's similar to the stock market, if we hit S&P, so if we search SPY and pull up the S&P 500, if we pull up a 1-day chart, this looks horrible. The 1-day chart on the S&P 500 is down 2%. Okay, well let's look at the last 6 months. Also bad. Okay, so that doesn't give you the full picture. It looks better than the 1-day chart. It's pretty much nothing but a straight line down. 6 months, it just had a recent drop and is starting to recover. But on the 5-year chart, it has its ups and downs, but it's particularly on a straight line up. The same thing goes with these future contracts. The more further out you get, the more realistic of a price that you will see. So as you can see here, it's $3 a contract. Let's go significantly far out. Let's go to January 2021. So about a year from now. These are trading at $30 a contract because they're worth more. They have a more realistic price to them. They have more realistic price action. And the same thing, the further you go out, if we go all the way, what's the furthest one out? So December of 2022, $45 a contract. The same thing goes for these crude oil futures. The contracts are going to be worth more because they give a more realistic price of what the crude oil prices are really going to be. Right now, they're trading, the actual price of crude oil, I believe, is trading right around the 20s, like 24, 25, something like that. Commodities and futures really is not something that I pay attention to a whole lot. I do watch natural gas a little bit, but this is just, it's just crazy to see. I'm going to get off this. I know I've been talking about it for a while now, but I never thought it would ever be possible to ever see a crude oil future contract trade in the negative. I believe, don't quote me on this, I think they were saying that the record before this May 2020 contract, the record before that traded at around $10 a barrel, which is so extremely low, and it definitely never hit zero before, and negative has never been seen before until Monday. So that is crazy to see, and it's definitely cool. The only cool part about this is that we're literally witnessing history. I doubt that in my lifetime I will ever get to see this probably ever again. So that's crazy to see. So let's get into my stocks and let's look at Qualcomm and Southern Company. We've had two other stocks raise their dividends now in the last 2 days since my last video. So Qualcomm Incorporated today announced that its board of directors has approved a 5% increase in the company's quarterly cash dividend. The quarterly cash dividend will increase from 62 cents to 65 cents of common stock and will be effective for quarterly dividend payments after March 26, 2020. The dividend increase will raise the annualized dividend payout to $2.60 per share of common stock. So let's go ahead and search Qualcomm here. Qualcomm does not raise their dividend annually. They are a little bit spotty. They don't have a specific schedule like a lot of my other stocks. But in the last 5 years, it's went from 48 cents to 53 cents, and they raised again to 57. And then for a while, since May of 2018, it has been stuck at 62 cents for about the last 2 years now. So now that they're raising it to 65 cents, it's good to show that they're still focused on growing that dividend and giving it back to shareholders. So that's something good that I really want to see. And as you can see here, I'm not going to read it all, but if you want to read, it'll be talking about how 5G and the development and the launch of 5G is going to make them extremely more profitable, and that's the whole reason why I wanted to buy this stock. The dividend is pretty good. It's nothing that's completely out of this world, but a 3 to 4% dividend is pretty amazing when you consider the potential behind this company. Their number one partner is Apple, like I mentioned before. Apple is the largest company in the world last time I checked, which is also another company that I own. It's very similar to Broadcom in the sense that they make microchips for cell phones and other 5G devices. So I'm really excited to see Qualcomm raising their dividend. I hope they raise it again next year, and I hope they even raise it more significantly than they did this year. 65 to 62 is not anything that's massive, about a 5% raise, but it's still good to see. I'll take what I can get. So the next stock we're going to be looking here is SO, Southern Company. It's one of the largest stocks in my portfolio. You can see here, Southern Company said Monday it was raising its dividend by 3.2% to mark its 19th straight year the utility has raised its payout. The quarterly dividend will rise to 64 cents a share from 62 cents with the new dividend payable June 8th to shareholders of record on May 18th. Based on current share prices, the new annual dividend rate would imply a dividend of 4.63%. And it talks about how it's higher than the average utility sector ETF. So Southern Company raises their dividend. The main reason why I wanted to own this company, I mentioned this before. So if we go to my portfolio here, the Southern Company is one of the largest stocks in my portfolio. So as you can see here in my portfolio, it's currently the fourth largest by value. It's tied for the third largest in percentage at 6% of my portfolio. So it makes up a pretty good chunk, and I'll definitely be buying more of the stock. I mentioned in my previous videos is that I have different strategies with different stocks. So my entire strategy is dividend growth portfolio, but I like really conservative passive investing on need-based companies. So with Southern Company, for example, I mentioned that people are always going to need electricity. The demand for electricity is not going away anytime soon. This company is going to be slow growth, but it will be steady, continual growth in almost any economic environment. In times like now, where a recession is taking place, so many business models are going to be struggling and their sales are going to be down. Electricity is pretty much going to stay relatively the same. It'll be slightly up and down in coming years, but for the most part, it's just going to be a steady, slow, gradual increase up, and they'll increase prices as well. So as you can see here, from 54 cents, and then they raised it again to 56 cents, and then a 58, and then a 60, and then they keep on following the pattern of raising it about 2 cents every single year. So now they're up to 64 cents. They'll be paying that in a couple weeks. So the same thing goes with Southern Company as with a lot of my really steady old Dividend Aristocrats group, which I'm sure Southern Company will be in the Dividend Aristocrats group one day. These companies are very safe, stable companies, and I love to see that they're raising their dividends, so that'll just be increasing my annual income. And speaking of annual income, let's go ahead and look at my spreadsheet that I'm making. I showed the spreadsheet in one of my previous videos. This is my current annual income from the 30 stocks that I own, all the way down from Broadcom, all the way down to Verizon. And this is what my annual income was when I started this YouTube channel day one. I'm going to be updating this monthly. I just plugged these numbers in. These are from my previous video. We're going to be updating this. This is my portfolio value from the day I started with 1,500. That's roughly about what it is today. My monthly dividend income, I'm updating that as we go along. And then now we're going to update my annual dividend income. So as we can see here, we're going back to my portfolio, and let's go to Southern Company. So Southern Company, as you can see, I'm opening it right here, I have 1.85501 shares. So we're going to pull out the calculator here, and we're going to take 1.85501, we're going to times that by 0.64, and then times that by 4, because that's what the annual dividend payout is, and then we're going to times that by my number of shares. We get 4.748, so $4.75 if you round that up. So we're going to update that to $4.75. So if we go down here and we look at Southern Company, so this number right here that I'm typing is what has increased since the month that I started. It is up to $4.75, so it is an increase 49 cents this month. So this month, Southern Company's dividend will be raising 49 cents for the month, and we're going to be updating that total as well. But first we're going to go to Qualcomm, and we're going to update my annual income for Qualcomm as well. Qualcomm, if we scroll down to the bottom here, with Qualcomm I own 0.44385. So we're going to be putting that in my calculator, so 0.44385, then times that by 0.65 times 4. So that is $1.15 in annual income. So let's go back here, and $1.15 in annual income. So that will be increasing 0.05. So we'll be updating this monthly total here. So from $4.21, that will now be $4.41. That'll be another 20 cents in annual income, and then we'll be updating this in total right here. So this total right here will now be $71.08. And then that'll plug in the difference right there. It'll show up there now. So it's cool to see, even though it's such small amounts, because I only have about $1,700 in the portfolio right now. We'll be growing it every single week. And those of you who do watch my videos, especially to the end, know that we're going to be growing this in the long term. Right now, these dividend payments will be dollars and cents. Like I said, my smallest dividend here is 38 cents a year from Apple. 38 cents is obviously nothing that I can deal with, and the highest one is Broadcom at $6.56. While they're not large amounts, you can see how it's growing every single month. We've only had this portfolio 3 weeks, and it's already went up $4.41. Next month, it will probably go up $5, $6, $7, $8.51, something like that. So every single month, this will continually get higher, and eventually the compounding is going to get significantly faster as we take the cash from our portfolio and continue to reinvest it back into our shares. So those of you that watch to the end, make sure to use this link, as I like to mention at the beginning and end of my videos. If you want to use M1 Finance, use this link right here, and then you can get $10 from me, and I can get $10 to put back in my dividend portfolio. Let me know down in the comments what you thought about this video, what you think about crude oil and where it's going, and also let me know what you'd like about future video ideas, any questions about stocks, and what you think about my videos. So thank you guys so much for watching, and I'll see you next time.